jobs were placed, you know, so unemployment's coming down a little bit, and boy, but yeah, it's been pretty volatile. The 2020 has been, I would say, probably the most volatile year I ever remember. But we're all getting through it, and we appreciate you taking time out of your busy day. And you know, we promise to make this as informative as we possibly can for you, and shed some light on it. So.
Absolutely.
Yeah, Lucas, anything you want to say?
Yeah, just as many of you probably know, as Jim alluded to as well, the House and Senate just passed some legislation. I believe it was Wednesday night, either Wednesday night late or early Thursday morning, to get some changes through for the Paycheck Protection Program. Some much needed changes that we'll be going over as we go through, and create some more questions. And there's still some questions out there, but I think there'll be welcome changes for a lot of businesses. Yeah, and Donald Trump is expected to sign it here soon, so we expect those to be through, and it should allow really most businesses to get their loans forgiven if you're in business. So. Yeah,
we really like the changes that were made, definitely pointing more toward a lenient requirements in order to have the PPP loan forgiven. So, and we're going to review what those changes are. We kind of started with the platform of the last presentation that we did, just so that we could highlight what was the original bill that passed.
Yes.
And then highlighting the changes so that we could see the differences. I mean, just thought maybe that would help, bring a little more clarity to it. So
yeah, yeah. So we had done that utilizing the application for forgiveness that came out a couple weeks ago. We had made some changes to the presentation, and then with this new legislation, we went through again and made some additional changes that are very evident on the PowerPoint, which will be available for download. And then as we get more information, there are already some expected changes to the legislation. We'll put that out through a newsletter, and the video will also be available online if you or somebody you know wants to check into other things there.
On our website.
On our website, yes. One other thing, there's a new question and answer area on the Zoom meeting. So down at the bottom, if you click Q&A, you're able to put a question in there, and we'll be able to see that question and respond to it either in the Q&A, but we'll try to respond to most of them in the webinar here. So utilize that. If you have any technical problems, our marketing person, David, is on here as well, and I think he'll be monitoring the chat. You'll see him on the listeners there. You may be able to chat directly to him, but if you put in the chat, if you're seeing any technical problems, or if you email us later, if you notice anything, we'd appreciate that, just so we can continue to improve what we're doing here to help you guys. So.
Great, well, let's get to it.
Switch over to the PowerPoint here.
First slide.
We'll start at the beginning, unless you want to start at the end. So yeah, now more than ever, as we see, still continues to be a very VUCA world. Still looking for some of that vision, understanding, clarity, and agility, working through all of it. And that's really what, one of the positive things we see is all of our business owner clients and individuals just finding the positives and new ways to work, being flexible, and finding ways to get through this. So,
I mean, going through this where we have had to really adapt pretty quickly to more of a remote virtual work environment. One thing that I have noticed is kind of like, a lot of this technology has been around a long time, and those who really take the technology were, I think, willing to dabble in it, very early on. But then there are the others. The other side of it is maybe people who don't adapt to technology really quickly. This really caused us all to get to a new elevated sort of playing field where, now it's like the new normal is those people who weren't comfortable with working remotely or in a virtual environment, using Zoom, other types of programs like this. It's becoming actually kind of second nature now to many of us. And it's opening up a lot more opportunities in terms of, hiring across states, providing services to businesses that are maybe not in our immediate geographic area. And so, just as an aside, I think that, if we can take anything positive out of this is that it's really forced us to reinvent how we're working and showing up in our businesses. So, but yeah, definitely a VUCA world. It's very, very, a lot of uncertainty out there right now. So
Yes.
but we're working through it and getting through it. So let's review today's objectives.
So yeah, today's objectives are really to look at what's changed since our last presentation. Again, the presentation shows really what it was last time with very clearly showing what's changed. So we thought that'd be a good format for anybody that may have missed the last one and that they can see what we're putting through there. Going through again the potential pitfalls and clarifications, how those have changed, and then thinking strategically what to do going forward, how to approach this as we go.
So what can we use the money on? Obviously, everyone's familiar with, that payroll is really kind of front and center. It's really the whole purpose of this program was really to keep people employed and keep money flowing into the hands of W-2 earners. So, obviously the money can be used on payroll costs, which is one area that has been, that the SBA has provided some clarity on, that it can be paid or incurred. So Lucas, do you want to speak to what that means?
Yeah, so what they mean there is if it was paid during the covered period, which was 8 weeks, is now 24 weeks. If it's paid during that period, or if it's incurred during that period, as long as it's paid by the next regular payroll, you can include those costs as part of the forgivable, or the allowable uses and the forgivable uses, which we'll get to on the next slide, very much the same. But yeah, so basically if there's a couple days at the end of the period that are unpaid, as long as they're paid on the next payroll, those can be included in the cost.
You can take that pro rata portion of that payroll and include it in as part of the covered period payroll costs.
Yes, and if a payroll is paid on the first day of your period, even if it was for 2 weeks ago, that
counts.
Is also in there. So you can't use the same cost twice, but as long as it was either paid in there or incurred in there, you can put it into these costs. They made that clear on the application for forgiveness. So, and
then mortgage interest payments. This is on real property and personal property. As long as that purchase or that purchase occurred prior to February 15th. So in other words, if you ran out and you bought, an office building or something like that, in early March, those interest payments wouldn't be included. But if it was, something that you had purchased prior to that, now that includes, our interpretation of personal property is, vehicles, any equipment, you have like CapEx spending, a term loan on maybe a phone system or computers or a copier or any of those. And again, it's the interest portion only. So you would need amortization schedules on those to capture what the interest was during that covered period. But it's a lot of times we hear the word mortgage and we think it's only real estate, but it can actually be real property or personal property.
Correct, yes. And then rent or lease payments, basically for the same categories, as long as that agreement was established prior to February 15th of 2020. Utilities were one that people were like, okay, what's a utility? They listed out several in the application for forgiveness: water, electric, telephone. We threw in cell phone. We're assuming that goes with telephone. They've got internet, and then they threw in transportation, which we've got some questions on what does that mean, but that's in there, transportation costs.
We don't know, does that mean public transportation? Does that mean fuel, gas, auto repairs, we really don't know. So for everything that they provide clarity on, they usually, it involves, one or two additional questions now that are unclear.
Yes.
So this happens to be one of them. They threw transportation in there, but we're assuming that that would relate to, probably auto operating, certainly public transportation, and that sort of thing. So.
Yes, I do have one question here on the payroll costs. Are they still capped at $15,385 per employee with the new longer period? We haven't seen that. I'm assuming it's still going to be 100,000 annualized.
Annualized,
is
so
what it actually says. The $15,385 is listed in the forgiveness app for owners for the 8 weeks, which is still 100,000 annualized. So we're expecting that to be a higher number for owners and for employees. Yeah, so as we have more details on that, and I've got a worksheet that we're updating related to all these that we can flip through later. That'll be in there, but we're still expecting it to be 100,000
annualized, right? So
yes.
It's kind of my take would be that it would be probably it would be three times that.
Yes.
Three times that.
That's fine as well.
Mm-hmm. So about 46,000.
Next on the allowable uses, and these two are a little different than the forgivable uses. Interest payments on any debt incurred prior to February 15th. So that's saying that you could use the money for, say, credit card interest or something else that's an unsecured debt, and then refinancing part of the EIDL loan for the few people that have got those.
Certainly nobody got it before April 3rd anyway.
Yeah, from in our experience, we haven't seen that. The original guidance was that it had to be used on these costs prior to June 30th. I believe that covered period is also going to be extended to December 31st. But really the forgivable uses are what most of our clients have been interested in. So the next slide goes over those, which again, basically the same. It just takes out those last two. And again, was originally the 8-week period following receipt of the loan. Some people have questions now on whether receipt means when you were approved or when you got the money. We've been using when you got the money.
You got the money, right? When you were funded.
Correct. There is an alternate covered period now for payroll. I don't know how that will go with the new 24 weeks instead of the 8 weeks. It'll make it much less relevant, but they were allowing people to wait to start their covered period until the next payroll period. So if you had a couple days until then, again, with it being paid or incurred,
don't know that it matters much.
Not seeing why it would matter too much, but and that only applies to the payroll costs. So
let's face it. I mean, if our loan was based on 10 weeks of last year's payroll, and assuming that employee levels are relatively close, matter of fact, they can even be down over last year by actually quite a bit.
Yes.
That having the 24 weeks to use the 10 weeks worth of payroll last year, and then also having some of the non-payroll costs also eligible, right? Your rent, your utilities, and all of that. I would say by and large that any business that is still a going concern that has, at least a similar number of employees as last year, even if they're down a few, you're really going to have no problem getting this loan forgiven.
Correct. That's what we're working with everyone on now is if you're back up and running or can get back up and running, you shouldn't have a problem getting this loan forgiven as long as you can get at least, say, 40% of the employees going. A big part of that is the FTEs, the full-time equivalence calculation, which we haven't seen how it would change, but as long as they're averaging it over the whole 24 weeks, it will be much less of an issue if your payroll is 3 times as much as it was going to be before. So that gets into the whole calculation, but nonetheless, it should be a lot easier to get it forgiven. That's the whole goal of this. So. But yeah, these are the allowable forgiveness costs. As we said, they're about the same as the use costs. And I think everybody's pretty familiar with these at this point. We've got a slide later, and it's in the application what they have for documentation that they're going to want for these. For the most part, it's your payroll reports. And then they list a whole lot of other things, which we'll see from the banks what they'll want, but they're generally the records you would keep for business expenses, you know, canceled checks, payroll reports, your payroll tax reporting. So as long as all that's being taken care of, you should be in good shape. We haven't seen anything.
Signed leases.
Yes, signed leases, exactly.
You know,
we haven't seen anything that says you have to have a separate bank account or anything like that. They're really just looking to see that you had expenses. So that's going to be the main thing. Just keep your records tight. The stars up here for the covered period. In the original act, they listed 2 covered periods. Not sure how that'll interact with this new longer period, but it shouldn't be as much of an issue. That we're expecting them to extend both of them through the end of the year, or this 24 weeks. So I think that'll simplify some of that for us. What are payroll costs? This didn't really change at all. There were some clarifications in the application just on how they were applying the calculation. But basically, it's your gross salary. That question comes up a lot. Is it the gross or the net? It is definitely the gross. Mm-hmm. There was some terminology even in the original act that made it sound like the withholdings would not be allowed, but the SBA has confirmed that they are. So it's the gross salary. Including tips. There's other stuff in there like severance, anything like that that's paid, vacation, family, medical, sick leave.
But the act is silent on bonuses, and we get that question all the time. Hey, you know, my wife is making $50,000 a year. Can I bonus her extra to bring her up to 100 grand? You know, so that I can utilize some of the forgivable loan and that sort of thing. You know, the act is silent on it. I think here's where I think it's going to go. Some businesses have had to maybe entice their employees to come back to work, right? So they've had to maybe give them, you know, kind of a back to work bonus of some sort. In my opinion, you know, it's like a market-based bonus that you had to pay in order to get your workforce to come back to work, you know, as opposed to maybe saying, well, you know, I'm going to take a big bonus and pay it to myself to utilize it. So, but it's not crystal clear on whether bonuses are included. I think it depends on what the bonus was for. Yep. And it also, if it's in the normal and customary part of their business where it's like, hey, we do bonuses every June and we always have, you know, you probably have an argument there. Again, I think it becomes less of an issue with now that they've tripled the amount of runway we have to use the money. But you know, bonuses are still not crystal clear as to whether or not they're eligible.
Yes, and I think it's going to come down to, as long as it's reasonable and all your documentation is good, that it shouldn't become an issue. If they get into, especially some of the bigger loans, and there's some clear abuse of that, where people are just paying a ton of bonuses to get it forgiven, but not hiring employees back, that's what they would really be looking for. But like Jim said, normal and customary bonuses, reasonable type pay to employees should be fine. So
Agreed.
Okay, next slide here. These were just a couple changes from the forgiveness app that I believe we talked about. The paid or incurred, if it's paid or earned during the period and paid by the next normal pay period. And then there's that alternative covered period. Again, we don't see that this is very beneficial for most people, but a case could come up where that could be. So those are in there. Here. So the 75-25 rule was originally there was a question of whether it was a cliff, so that if you didn't hit the 75% of your loan amount, so say your loan amount was $100,000, if you didn't have $75,000 in payroll costs during the 8 weeks, would that mean that none of it was forgiven? Well, they clarified, no, it doesn't. The application shows that it's a sliding scale based on your payroll costs.
Right, that was the rule as it exists now before the president signed the new rule.
Correct. So the new legislation that went through changed this to 60%.
60-40, right.
And so it only needs to be 60% payroll. The issue with that is now the question has come up again, and it seems a lot clearer in this language that it is a cliff. So if you don't hit that 60%,
you got to pay it all
payroll,
back.
That none of it's forgiven. Now they've committed and they've said we're going to change that. That's going to be a clarification that the SBA or somebody makes after the fact, after it's signed. But they wanted to get this through. The way they got it through so quickly was by using unanimous consent. So if they can get unanimous consent from all of the senators, they can move it right through and get it to the president. I think there was one senator holding out, and they kind of got him in a good place and moved it right through.
It was Ron Johnson.
Yeah, and to do that, they couldn't make any changes to the bill. They had to just push it through, unanimous consent, and done. So they had to leave a few things in there to get it through quickly.
So definitely more lenient hurdle to overcome.
Yes.
Most people, I think, are going to be well above the 60%. So I'm not really anticipating, again, you would have had to, like you were saying earlier, before we started the webinar, you essentially have to be out of business.
Yeah.
To have not, I mean, if you're still a viable going concern and, yeah, sure, maybe things have gotten a little tight, but you're keeping most of your employees and you're plugging along, that extra runway is going to allow us to utilize that. And like I said, they lent us the money based on last year's payroll in 8 weeks, and now we have 24 to use it. Some of these other costs that are non-payroll are kind of like just sort of sprinkles on the Sunday, so to speak.
Yes.
But most of it, we're going to have plenty of payroll to use that up. So the cliff thing doesn't scare me that much. Hopefully it doesn't scare many of you. Yeah, we do think that they will change that, and soften that up.
Yes, I think it has to be changed. I think it's really just an interpretation, because what if you just don't report these other costs? Like, there's so much ambiguity there. They've narrowly defined them, but it's really what you report that determines it. So the way it was calculating with the 75% is you would calculate your payroll costs, and then you divide that number by 75%, and that was the max amount you could have forgiven. So the other amount had to be made up of all your other costs. Right. We assume that's going to be the same way with this 60%.
Yeah, you're right. You just exclude those. And then 100%.
That's 100%. Right. Yeah. So, and there's so much ambiguity there. Are they going to really come back and say, no, you actually had more costs in this area, in this bucket, and then say, so we have to reduce your loan? That seems a little
impractical.
Silly. Yeah. So we'll see. I think that is one that'll get fixed.
There's definitely the momentum is moving toward, and just with the lack of clarity, which we will get at later, the lack of clarity and the lack of attention given to the terms of the loan, how it will be paid off. I mean, there's virtually nothing out there about how the terms of the loan are to be set. Are they going to be in principal and interest? Is it going to be interest only and then a balloon at the end? There is zero language that we can find that talks about that. And the only conclusion we can make is they're spending all of their energy on how to make it easier for the loan to be forgiven. So we kind of look at that as almost like they're tipping their hand a little bit, that they're going to spend their efforts on loosening up the rules to make it easy for it to be forgiven. Then the repayment of the loan becomes a bit of a moot point.
Yes. Yes. Excuse me. I think that is the case. They really intended for most, if not all, these to be forgiven. And the 60% was a little bit of a contentious thing, because the other intent was that, companies brought back employees, and that's been a whole other deal with unemployment being higher, having a hard time getting them on the payroll, companies not being able to open. So it's like, why even have that fight if we can't open and we're just going to pay them to be home? So that's been a whole kind of undercurrent here, but this is a welcome change that will help really some of the hardest hit businesses be able to get it forgiven or mostly forgiven. So that's really good. As I talked about earlier, the full-time equivalents and rate reduction. This is one of the harder parts to calculate in the application, and I know most people are saying that the application is really like a tax return, and it's probably going to need the assistance of your accountant to help you through, which, you know, we're glad to help everyone get that done. But what it says is basically that if you've reduced employee count compared to last year, or an alternate period that you see on here, that will reduce your payroll costs. And the way it does that is, say you have half the employees, then you would take your payroll costs and you would take it times 50%, and that's your adjusted payroll cost that you can use in the calculation. With this 24 weeks, your payroll costs will be a lot higher, so that should be less of an issue.
Right.
Half of a lot bigger number should still make your loan amount. So we're waiting to see, we assume it's going to be the average FTEs over the February, over the loan period of the 24 weeks. And then what they did say is that the safe harbor is now pushed out to December 31st. So it used to be that if you restored all your employees by June 30th, that none of the FTE or none of the FTE things mattered, but they pushed that out to December 31st. There's also something in there that if you reduced the rate for your employees by more than 25%, that anything over that 25% reduced your payroll costs. It was an adjustment in there. That has a safe harbor as well, and if that's restored on the payroll that includes that December 31st, that should go away as well. So there's a lot of complexity to those calculations. If you've had a big change in employee counts or reduced wages, we'll need to look at that and go over it and just make sure we get those calculations right. But again, with the longer period, that we're assuming that the calculation will be a lot easier to.
And I think we can all say too that there's a pretty high probability, at least I hope so, that the second half of the year is going to be better than the first half of the year. So, you know, hey, by the time we start getting into Q4, I think, you know, we'll see more hiring happen, and unless of course we go into remission or something, or yeah,
let's hope a resurgence or whatever they're talking about. Right. I know the schools, that's a big thing there. But yeah, I know one of our clients talks about it being either a V-shaped recovery, which I believe means like a very fast recovery, or like a swoosh shaped, so like a slow kind of moderate recovery, and how they might legislate based on both of those. He thinks there could be another tranche of these PPP loans for businesses that have already got one. I don't know how that plays into this now 24 weeks, but anyway, I think they'll keep trying to keep the economy afloat and keep doing that. So, okay, next here. We kept this slide in, which is how the PPP loan interacts with payroll credits. Really, the only thing that changed here is that this new legislation says you can use the Social Security tax deferral if you get the PPP loan forgiven. Before, you could only use it until it was forgiven, which now that's going to be a much longer time anyway, really through the end of the year. So that's probably why they took it out. That's the employer portion of the Social Security can be deferred through the rest of the year and paid half in 2021 and half in 2022. We think that's pretty limited benefit and kind of a lot of paperwork, and kind of could sneak up on people when they owe it at the end of 2021 and 22.
Right.
But that's out there as a possible easement if people need it. The other credits cannot be used as payroll. If you, let me make this clear, because this question does come up a lot, or it's kind of hard to understand, but if you use the expanded FMLA or the 2 weeks of employee sick leave that are related to the coronavirus, and you code them as that so that you get a payroll tax credit, that payroll cost cannot be included in your payroll costs for forgiveness.
Right, because you can't double dip.
Yeah,
You can't take a credit on your payroll tax returns for the payroll you paid for the expanded FMLA or the sick leave, and use those same payroll costs to relieve the loan. Don't think you're going to need them. If you do have some folks that are on FMLA,
Yeah, I mean, generally, unless, it's like half your workforce, it seems like it would make sense to just utilize these and get the credits, because I think everybody will have enough payroll costs.
Yeah, so really try to do both, but you can't use the same costs for both programs.
Correct. And what we've told our clients that we do payroll for, and then other ones that have payroll services, is if you got a payroll service, there should be a coding in there that can be set up to record these, and then that takes care of everything. If we do kind of an after the fact payroll, just let us know, in the next week or so here, so that we can get ready, because the new payroll tax forms are really bad. They've got a ton of new boxes. We've got to put all these numbers on different lines. So making sure that we're tracking those correctly, and anything that you're getting credits for, just that we can put it in the right box, and getting ahead of that.
And if any of you who are attending the webinar today, prepare and file your own payroll tax returns, please don't hesitate to give us a call if you want us to look them over, or to maybe provide some direction. The form will look different, and from what I've heard, like Lucas said, it is quite a bit more onerous than the original. So if you do have FMLA, or you've got emergency sick leave pay, and that part of the form does play into your filing, and you're filing them yourself, it's expected to be a little more difficult.
Yes, definitely. I've got a question here about Federal 941 and Illinois 501. So those are your withholding taxes. So yes, those are forgiven, but they're forgiven as part of the gross payroll. So that's what we were saying before, is when you take your gross payroll, that includes any employee withholdings.
Right.
So then you don't take separately those. But if you have a payroll service and they take two separate amounts, pretty much both of those amounts are going to be part of your payroll cost.
With the exception of the employer's FICA and Medicare,
Yes.
That's part of your 941. Those are not eligible. So really, it's just your gross payroll.
Correct.
Plus state unemployment.
There will be an adjustment to that total amount that the payroll service is taking out. At the end of the day, we're going to use the payroll company's reports, or our reports, to take the gross payroll. We're going to add Illinois unemployment.
Right.
And then we're going to get the health insurance costs and all the other allowable ones to put into the form.
But you really don't want to take those two numbers, like paychecks, for example. They have something called tax pay, right? So the first poll is all the net pay, and then the second one is all of the taxes, employees' taxes and employers' taxes, right? You can't just simply add those two numbers together and utilize that, because the tax number includes taxes that aren't eligible.
Correct.
So
Yes.
You really want to just use your gross pay number plus your state unemployment, or if there's any local employer taxes that you have to pay. But mostly for Illinois, it's going to be your SUTA tax that is paid to the Illinois Department of Revenue. So your gross pay plus any SUTA tax.
Yes. Yeah. At the bottom of your payroll report, there's usually a line for total gross pay.
Yeah.
So that would be the number that you would use. Okay.
So that answers that one.
Let's go to the next slide here. So some potential pitfalls in these, some of them still the same. This one is not as potent anymore, the requirement that it's only costs incurred and payments made within the 8-week period, because now it's 24 weeks. And we've got some clarification on that costs incurred and payments made. It is really both. It doesn't have to be, the same expense doesn't have to be incurred and paid. It's costs incurred, and if a payment is made on any expense. So
there's no longer two possible interpretations.
Correct.
Right.
This forgiven funds deductible, that's been a point of contention, because there is an Internal Revenue Code that says you can't deduct expenses allocable to tax exempt income. And the IRS came out several weeks ago and clarified that that does apply to this. So even though the CARES Act says it's not taxable, the IRS is saying you're not going to be able to deduct the expenses, basically up to the amount of whatever's forgiven, which is basically making it taxable, is what that comes down to. They've said they're going to fix this. We haven't seen anything on that yet.
Well, yeah, the talk that we're hearing from, from Congress is that sort of interpretation is not in the spirit of what the program was designed to do.
Yes.
Nobody is expecting to have to pay 30% of their PPP funds back in the form of taxes next April, right? I mean, we're just, so people are anticipating. So what we've been doing is treating it as what is called an M1 adjustment. If this is our plan, is to treat it as an M1 adjustment on the business tax return, where that is income reported on the books but not taxable.
Yes.
And then still deduct the expenses.
Now, what's interesting, and we had actually discussed this, since they've extended that safe harbor to December 31st, the application deadline is going to need to be into 2021, which
Right.
means there won't generally be forgiveness until 2021. So it could be taxed in 2021 if that applied.
Right.
You could defer it very easily by just withholding your application. Anyway, we think they will fix that, but we haven't seen it yet. And that's another one of those areas.
Yeah.
Okay.
Non-mortgage debt.
Yeah, the interest on debt that was incurred before the covered period, that was non-mortgage, that stuff can be paid, but it won't be forgiven.
Yeah, which we really don't understand what any of that means. It's like, because we're still operating businesses, we're billing customers, they're sending us payments, like we're paying other expenses with other sources of money. It's not like the PPP loan money is the only money coming into our organizations.
Correct.
Right?
Yeah.
I mean, who's to say that, I don't pull $10,000 on my line of credit so that I can, pay, your advertising or office supplies or whatever. So it's really like, in terms of just distilling the costs, like the money came in here, it's used specifically for that. And then we have other money that's coming in that could easily, we could say, well, it was that money that was used to pay these expenses, right?
Correct.
So,
and that's why it's looking like it's just going to be, give us an accounting of the expenses that are allowable, show us that you paid those, however you paid them, and that'll be.
We could have done without this language where it's like, this was allowable but not forgivable. It's like, I think it just complicated it.
Correct. This federal income tax withholding one goes to what we were saying, use the gross payroll, and then this isn't an issue.
Right.
That's more language that they added that really didn't need to be added. They could have just said gross payroll.
Agreed.
Self-rentals, as we said last time, don't seem to be an issue. And
you want to have a lease, though, have a lease established, it's signed. Guys, if you don't have one, write one up. And you didn't hear it from me, but
you should find the one that you
put the right date on it, okay? And I'm sure it's a lease that was signed before February 15th, and that, which is easier to do if you have like a regular recurring, loan, rent payment that has been going from your one entity to the other entity. You just want to build a lease that supports that payment pattern. Yeah, right.
At least make sure it's recorded on your books as, due to the other entity. If it's, paid a little bit out of, like not monthly, just make sure at least on your books, it's shown as an expense monthly and that you're paying that at a regular time.
But if you don't have a written lease, you want to try to find it. Yeah.
It's in a file cabinet
somewhere. It's in a file cabinet somewhere. Exactly.
The FTEs, that's going to be, it's a detailed calculation. Like there's not really a good way to shortcut it because you do have to look every pay period, get the hours for all the employees and divide by the 40 and then compare it to one of these other pay periods. There's several dates and all that. So really, if when it comes down to those, I think you'll need some help, and our worksheet may help, and we'll be here to walk you through those and help you out with that. So again, with the 60% rule, we're hoping that's a little easier hurdle to get over. For the forgiveness application, this is 11 or 12 pages of fun that came out. Originally, they were saying it was due October 31st.
Right.
Since they've extended this, they're saying that the last available date for the loan period is December 31st.
So we can't.
And that's the safe harbor.
Right.
So it's going to be due during tax season.
It's probably going to be like due April 15th. Why not?
Great. Yeah, that's a good time for it. Maybe March 15th.
Yeah, right, exactly. Right.
Maybe it'll be a new business schedule.
Right.
Yeah, so we're assuming this will be the same. The bank does a good faith review on that, and they're supposed to do that within 2 months, and the SBA has 3 months to finalize it. As we said, there's more clarifications to come on all of that.
Yeah, we wouldn't recommend filing. Well, first of all, they're going to have to update and modify the application once Trump signs this.
Yes.
But I would not consider really doing anything, filing the application, even if you're like, oh, it's a slam dunk, all these costs are covered. I would hold off.
Yes.
And not really think about completing the application until.
There are some businesses that, yeah, I mean, I guess if they extend the thing to 24 weeks, you're going to have to wait the 24 weeks to get all your costs on the application.
Yeah, before you can even do anything anyway.
Yeah.
So yeah, this thing, the due date is going to be pushed off probably at least 6 months from that.
Correct. So hold off on anything there. This is from the application. We copied it here. Huge list of documentation requirements. From what I've read, really the main thing is your payroll reports and your tax return.
If you've got, most everyone's payroll now is done digitally. It's done, it's processed, even if it's processed through QuickBooks or, through a payroll service provider, all the reports are in there. This should be fairly easy to prove the payroll records. Your
PPP loan document that you originally submitted. I've seen the EIDL. If you had an EIDL advance, that's factored in here, so they will need your EIDL loan number, that advance amount. Then they get into canceled checks and receipts. Man, that's a lot of canceled checks to put together for all of these costs. So I really hope they will change their mind on that, because nobody even gets canceled checks anymore.
It's all direct deposit, and
ACHs.
Your payroll service does one big sweep out of your bank account or two. So
yeah, this seems intense, and hopefully they'll clarify with the banks what it originally said in the act, that as long as the business signed off on the expenses, that, hey, these are my expenses, that the bank was in the clear. Yeah. I'm sure just like with the application process, they'll go back and forth with the banks to come up with what's going to be reasonable, because this would be a mountain of paperwork.
I think a lot of this stuff isn't going to be necessary if you can already gobble up all of the PPP loan money with just payroll. Then are you really going to need to pull Are you going to need to pull amortization schedules? Are you going to need to get canceled checks for your Comcast bill? Are you going to need to do, I'm thinking that this list becomes a lot simpler with the extended payroll period.
Yes. Yes. And they listed as documentation requirements, and they keep that for 6 years. I'm thinking that may end up being more like with a tax return. You're supposed to keep your receipts, but only in the case of an audit would they really go deep on that stuff.
Exactly.
That we'll see as we go.
But 6 years, you want to keep these records for 6 years. Any documentation that you used to substantiate the forgiveness of that loan, you're going to want to keep that somewhere for 6 years.
Yes. This is just a summary that we put together of the House bill. Very simple right now.
The highlights.
As we're still, going through it. It isn't even signed yet. The president's expected to sign it. We just wanted to put that all on one slide. There's also something where they're saying there is more leniency in there, like some additional things for companies that could not reopen, so that
hospitality, restaurants, even restaurants, I think, would still count, even though they're doing curbside.
Correct. Yeah,
because they're materially impacted. But hair salons, right? Spas.
Yeah.
that sort of thing.
So I haven't seen how that's going to be calculated or affected. I'm guessing it'll be something with the FTEs or give them just an easier time. But again, I know we've said this a lot of times now, but with the 24 weeks, as long as they get back up and running, it should be easier. But
Yeah.
still, if there's a resurgence or something, this could come into play, and they could need it. So some things that still aren't clear. Loan repayment terms. Is it principal and interest? Is it interest only?
Well, and here's an interesting thing, because they said the first 6 months, there's no interest. Okay, so if I got my money April 1st, right, that puts me to, is that November 1st, October 1st?
August?
6 months. 6 months, right?
Before this, well before December 31st.
Right, well before December 31st. So it's like supposed to convert to a loan before the, like
before it's forgiven.
Before it's forgiven.
Before you can apply.
Before you can apply to forgive the loan. So like we have like a disconnect there, basically. What I'm trying to say is that, you know, they're basically saying that there's going to be payment terms that are going to kick in before we've even determined officially what the forgivable or unforgivable part of the loan is. So they're going to have to change that. Yeah. Right.
And that like we said, that may be in there, but it goes to the fact that they really want to forgive these.
They want to forgive them, and because there's not clear, you know, if I've got a $180,000 loan and I've got 18 months that I've got to pay it back, well, now it's been extended, I think, to 5 years. So is that going to be principal and interest over that 5-year period of time, or is it going to be interest only with a balloon at the end?
Yeah.
Like I said, they're not spending a lot of time focusing on the terms of the loan repayment. They're spending all of their time on how to make the loan forgiven. And I think that's a good sign for all of us, actually, if you ask me.
Yeah, I agree. Expense specifics, we kind of touched on these, you know, utilities, that they answered some of it, but then they threw in some other ones. Transportation, the telephone, we're assuming that includes cell phone. There's a question out there about owner's health insurance. There's a lot of language about self-employed people and general partners and their health insurance and whether the expense is deductible. And then we get into some IRS stuff that's like attribution rules, which basically means, well, is the family's health, if the family happens to work in the business, is their health insurance deductible? So hopefully we'll get some clarification on that, but we should have enough payroll to cover it. Hopefully we'll have enough payroll without having to get into those questions. Deductibility.
Again, getting back to that IRS rule, are those expenses deductible since they were paid with tax-free money? Are they deductible? So
the payroll costs, we did say incurred or paid. However, with some that aren't paid on that next payroll, for instance, if you have a match on your retirement that you don't pay till the end of the year, is that okay? Because it is paid at the regular time, but it wouldn't be due on the next payroll. So there's some question on that as to whether that.
I mean, I guess you could determine the accrued amount and then just make a special payment, accrue it year to date, and then make it. Nothing that says you can't do that.
Correct. The application due date, we mentioned this, the deferment of payments, and then bonuses.
Like we had talked about. Yeah.
Okay, so as we said, we've got some time here for questions.
And that's really everything we know. I mean, you know, it's definitely, there's some things that are clear. It created more things that aren't clear. But one thing that is clear is that there's a trend toward loan forgiveness.
Correct.
And I think a big step toward it. I think they really made a statement when they tripled the amount of time.
I agree, yes. And I'll open up real quickly to share. And as we get this updated with more clarifications, I'll show you the tool we were creating for, which has gotten a lot longer, for calculating the loan forgiveness. And let me switch screens here real quick. to that.
And by the way, Lucas, I gotta say, like, you put a lot of work into this thing. I mean, poring over the application and then putting it all together. And then a day before the webinar, they basically change all the rules, and now he's got to add another how many weeks?
Yeah, I added the 16 weeks here, so you see it got quite a bit longer. So we got to fix that and get it out there. But what this does is allows people to put in their gross payroll, the health insurance, retirement paid, state employer taxes. These amounts calculate on another sheet. That's why they're grayed out here. That's the owner excess wages, the payroll over 100,000, and the wage decreases. I've got to update those once we get the details on that. The wages for where credit was obtained for FMLA or sick leave, like we talked about, so that has to come off of there. And then if there's any other reductions, I just kind of left a line for that. And then this calculates based on the FTEs, those full-time equivalents. If there was a reduction, it calculates that. I'll show you that sheet in a second here to come up with those adjusted payroll costs. And from there, it can determine, basically the application comes up with, I believe it's 3 numbers for the max amount you could be forgiven, and it takes the lesser of those numbers. So you've got your max loan amount, and then you've got your amount based on your payroll costs. So whatever your payroll costs are divided by 75% comes into that calculation. And then the other one is, what is the other one? I've lost my train of thought here. But there's a third one, and it takes the lesser of all 3 of those. I believe it takes out the EIDL loan is what the other one does, to figure out the loan cost. We think it'll be much the same. It's just going to use 60% instead of 75.
Right.
And we'll have all these costs in all these other weeks. So as you can see, the record keeping has increased quite a bit just looking at that. The FTEs, this calculates a safe harbor. So ask the questions based on the date in the application to see, can you go with this simplified safe harbor? And if not, then again, we get down into here where I've had to add another 16 weeks to calculate those FTEs. These are not supposed to be negative, but, and what this does, it allows you to use either a bi-weekly or a weekly payroll to figure those, comes up with the average for the loan period, and then compares it to the 2 periods that are allowed in the application. And again, it takes the better calculation. You're allowed to use the better calculation of those, plugs that into the calculator. And finally, the wage reductions. So owners, as we talked about right now, at 15,385, but we expect that to be times 3.
Yeah, right. Mm-hmm.
Employees over 100,000 annually. There are 2 separate areas. So if you had an employee that was making over 100,000 annually, it doesn't matter how much you reduced their wages. And there's 2 separate areas.
Like even if you reduce it by more than 25%, but
yeah,
they're still over 100,000, it doesn't hurt you.
Correct.
I still don't know why they separated I think it's just because they're nosy.
Correct.
They want to know how much the owners are getting paid.
maybe. So what this one does is add back if they're over 100,000, and then the calculation down here is for employees that had a wage reduction. Again, there's several date ranges that have to be calculated to determine if it meets a safe harbor, and then to calculate the actual add back if there is an add back in this PPP reduction.
I would say, guys, I mean, we're CPAs and it still makes our heads spin how this thing works. I mean, it really takes, there's a lot of different date ranges and thresholds and calculations.
It is not a simple calculation, and it's certainly not simple to explain.
You can only guess that the government created it.
Yes, for sure. So we're putting this through a lot of testing internally, and then having some clients use it. Really, obviously, there's a big disclaimer up here because really we want to use it in conjunction with us helping you out to make sure that the calculations are coming out right, so you're not relying on something if for some reason it were to calculate something incorrectly, just to make sure.
Right.
So I had some things in here, some keys from the original application, and maybe adding a cost ledger that people could put their costs in, that may be something we throw in there so that you could just keep a list of all the costs throughout the time period. But those should be able to be pulled from your general ledger pretty,
Right, I would agree with
easily
that.
just by pulling expense account general ledgers.
Right. Correct.
Okay, so that's Excel geek stuff. Let me stop that share. I see we've got one other question here. Let me go over to it. Figure that out. It's down here. There we go.
Yes.
Has any decision made? I haven't seen anything said specifically about union payments, but again, union payments are all health insurance and retirement benefits.
I mean, it's kind of like if you look at your real estate tax bill, it's broken out itemized that make up what the total real estate tax bill is. So I would say, like, if there's a breakdown of the union dues payments that says this amount goes toward the pension, this amount goes toward health benefits or whatever, that I would think that you could pull those costs out of the union dues and count those. But I think, you know, just dues in general, I don't know that that's really considered health benefits.
Correct. And I think usually there is a breakout. So that, like you said, the stuff that would fall into those payroll costs areas, I think would definitely should be allowed. I would include it if it was me, but we haven't seen anything specific. And I've searched quite a bit for this to see if anybody said anything specifically about it. And that's all I've found is people saying about the same thing there. So.
Good questions, and really well attended. I mean, this was really great. You know, it means a lot to us that so many people decided to participate and to be in on it. One other thing, you could maybe save the date. We are right now preparing for. We're taking our first Partners in Growth event virtually. You know, normally, you know, we would host it here at our office, you know, after hours and create a bit of a networking environment and talk about something relevant topics for this next one. And we certainly hope we're going to be able to bring these back where we can all meet and see you guys in person and get caught up on things. But in the spirit of wanting to continue Partners in Growth, we are setting our next one as a webinar on June 25th at 3:30. So it's a Thursday, and the topic is going to be shifting from surviving to thriving in a post-pandemic environment. So we're excited about that. I think you know, in the next 18 months, I think we're going to see a resurgence of the economy. At least that's my plan and what people a lot smarter than me are telling me. So we really hope that that is the case. But yeah, shifting from surviving to thriving, which is, I think, we're all ready for. Definitely, I know I am. So.
Yes, and that as we get more information about the Paycheck Protection Program, we will either have another webinar supplementing with some newsletters to get out that information, and then we'll have this. So I do see a couple of questions.
We got okay. Are you going to send the wine to our individual offices for the Partners in Growth? You know what? We actually thought about doing that, you know, and I had one of my associates, actually David, who's on, you know, I'm like, you know, we should like set up, we should like send for like the first 25 people that attend, like a little bottle of gin and tonic water or something like that. And he's like, oh, I don't think we can like mail alcohol. I'm like, you know, the marketing guy shouldn't be the wet blanket. Jeez. David, you know, you got to just, you know, can't always, you know, play by the rules, you know. I mean, what's wrong with mailing a bottle of wine, you know? No, but in all seriousness, we do ask that you maybe, you know, feel free to bring your own bottle of wine. It'll be a BYOB Partners in Growth, which I promise to make it up to you next time. Maybe we'll put some better, I'll put some better stuff out next time when we meet in person to make up for it.
Another question that came through, what about guaranteed payments? From our understanding is that for partners and LLC members, that the number they're using is their is it the self-employment income number? Yeah,
the amount that's subject to self-employment tax.
Right, which would include your guaranteed payments. So yes, that should be part of it. Again, it'd be max of 100,000 annualized. But that should be part of that calculation for payroll costs.
Consider payroll, right?
I'll put that in here in the Q&A. Okay.
Awesome.
So yeah, if we don't have any other questions.
You guys always feel free to reach out to us directly, either by email or by phone. If you have any specific questions after today's presentation, don't ever hesitate to call. And, we just love to help any way we can. And
Yes.
Again, as I said, I think I speak for Lucas, we're very grateful for all the relationships we have and for you taking time out of your busy day to join us and participate. So thank you very much. And you guys stay safe, stay sanitized, wear your riot gear, just be ready, prone position.
Yeah.
And have a great weekend.
Thank you all.
See you later.